In this video, we'll be discussing how to calculate the cost of investment, which the parent company records in its financial statements, and it will be used for the calculation of goodwill value too. Okay. So in this case, Jack acquired 24 million $1 shares, which is 80% of the ordinary shares of Becky company by offering a share for share exchange. Now, it's not necessary that whenever a company acquires another company, they will always use cash. Okay, for obvious reasons. They can also issue their own shares to purchase the share capital of the subsidiary company, like as in this case. So we have, by offering a share for share exchange of 2 shares for every 3 shares acquired in Becky. Okay. So for every 3 shares which the Jack company is acquiring in Becky company, Jack will issue 2 of its own shares. They will also give a cash payment of $1 per share payable 3 years later. So if you look up in this question, there are actually 2 ways of how Jack is funding the acquisition of the Becky company. First of all, it's their share consideration, which they're giving them right now. And then after 3 years, they will also make up a cash payment of $1 per share acquired. So that's going to be a payment of 24 million. Uh, that's going to be considered to be as a deferred consideration. Okay. So we have a share exchange over here and we have a deferred consideration over here. So 2 of them. Becky shares have a nominal value of $1 and a current market value of 2. So basically they are trading at a premium of $1. The cost of capital is 10% and the value of this $1, okay, is receivable in 3 years time can be taken to be as 0.75. Okay, so I'll tell you when you will have to use that figure, but for right now, first we have to figure out is our share consideration. Okay, so we'll do the calculations over here. So basically the total share capital is 24 million, and on every 3 shares being purchased, Jack plans to issue 2 of its own. So you divide by 3 and then you multiply by 2. That will become 16, which is 16 million to be the number of shares to be issued by Jack company to acquire 24 million shares of Becky company. Now, Jack shares have a nominal value of $1 and a current market value of 2. So we have to value it at $2. So that makes it up to 32 million. That's going to be the fair value of the share consideration which Jack is passing to Becky company. Yeah. So the first part of the question asks you calculate the cost of investment and show the journals, the debit and credits you record in the Jack's financial statement. So basically over here, the debit would be, we have an investment. So it will be investment in Becky company with a total valuation of 32 million. Okay. But as far as the credit is concerned, they have issued their share capital. So share capital will be credit, but you have to keep this thing in your mind that whenever you're recording the share capital transaction, it has to be at the nominal value. So in that case, it's going to be the total number of shares that have been issued were 16 and their nominal value is 1. So that makes up a total of 16 million. Okay. 1 second. Yeah. So that's 16. The rest extra, that's going to be again a credit and it will be a share premium. Okay. So the premium, as I told you, was $1. So in that case, again, it will be 16 multiplied by 1. So you will get 16 again. So debit would be the investment with a total of 32 million. The number of shares which have been issued are 16 million. Nominal value is $1. So that will credit in the share capital, and the extra, which is again 16 million, 32 minus 16 million, that will be credited in the share premium account. So that's how you're going to record your share consideration. Now, as far as the deferred consideration is concerned, you have to write it down at its present value. Okay. So in the accounting rules, anything which is to be received or to be paid in future, that's like after 1 year, you have to bring it to its present value. Okay. So for deferred consideration, you say that it's promised that they will pay $1 per share payable in 3 years later. Okay. So basically, we have acquired 24 million shares, and we are we're going to be paying $1. So in future value, what we have is 24 million, right? But we have to bring it to its present value. And for that, they have given you the interest rate of the company, which is 10 percentage, and the value of $1 receivable in 3 years time can be taken to be as 0.75. So that's basically the discount factor what they have provided you. Okay. In case if they don't provide you with a discount factor, you should know the formula for the discount factor, which is 1 divided by 1 plus the rate of interest, which is 0.1, to the power uh, the number of years. Okay. So it's 1 divided by 1 plus r, rate of interest, to the power number of years. So that gives you again 0.751. But as the question is mentioning over here 0.75, so we can just take 0.75, or we can also take 0.751. So I'll just take 24 multiply by the actual factor. So we get 18, approximately 18 million. So the present value of the deferred consideration is 18 million. Okay. So in this case, the entry will be again debit investment in Becky Company with the amount of 18 million, and this will be considered to be as your liability. It's a non-current liability with the name of deferred consideration, 18 million. So you have to record it as your non-current liability. Okay. So the total cost of investment over here will be 50 million. Total cost of investment will be 32, that's for the share consideration, and 18, that's for the deferred consideration. So that will give me a total of 50 million. 51 in this case, because we have just rounded up. Sorry, 18, yeah, so 50. So that's a total of 50 million over here. That's the total cost of investment, which you will be using it in the goodwill calculation too. Okay. Now, the next part of the question is show how the discount would be unwound. Now, because you have written the liability at a present value, every year you have to keep on increasing the liability, or what we call it as unwinding of the discount. So by the end of year, okay, what you have to simply do is that your liability is 18 million, and on that there is a interest rate of 10 percentage, so that's 0.1. So by the end of the first year, you have to increase the liability by 1.8 million, which is considered to be as your unwinding of discount. So that's considered to be as your finance cost. Okay. So we will say debit finance cost if you're making the income statement, but in case if you're making the balance sheet, we'll say group retained earnings debit with the amount of 1.8 million, and credit will be your deferred consideration. Your liability will increase with the amount of 1.8 million. So the balance of the liability at the end of the year would be 19.8 million. Okay. 18 million was to be recorded at the start of the year when you have purchased the company, and then over the period of year, you have to record the unwinding of discount, which is considered to be as the finance cost. You don't have to reflect it as part of the cost of investment. Over the 3 years, the liability will keep on increasing, and that increase is considered to be as unwinding of discount. And you have to record it into the income statement if you're preparing it as a finance cost, or in case if you're preparing the balance sheet, once you are doing the group retain working number 5, you have to reduce the finance cost from your group retain earnings from the total. Okay, so the total value of the deferred consideration at the reporting date would be 19.8 million. Next year, again, you will take your liability value will be 19.8. Okay. So I'll do it for the next year also for you guys. So it's 19.8 million now, and you have to uh, again charge an interest rate of 10%. So the finance cost for the next year, the second year will be 1.98. So for the first year it was 1.8, but then for the next year it will become 1.98. And for the last year, because you have to pay it after 3 years, and now it will be considered to be as your current liability. So initially, as you know, that we recorded the liability as 18, but then we increase it up by 1.8, and then we increase it up by 1.98. So now the value of the liability would be, here you go, it will be 21.78. And on this again, for the third year, you will have to charge 0.1, that's 10%. So it will become 2.178. That's the finance cost what you will be recording in the third year. So for first year, it was 1.8. Okay. For the second year, it's 1.98. And for the last year, it's 2.178. Now, if I total them up, actually, you can see that it's approximately going to be 6 million. Okay, and that's the unwinding of discount, because there was a liability of 24 million which we recorded at 18 million, so we discounted it by 6 million, and that 6 million has been charged over a period of 3 years, not in an equal way, but in the first year it was 1.8 because the liability was less, then it was 1.98, and then finally it was 2.178, or you can just simply round it up to 2.18 also. Yeah. Okay. So that makes up a total of 6 million interest expense being recorded over a period of 3 years. And once when you pay off that amount, in that case, the entry will be debit deferred consideration with the amount of 24 million, and credit will be cash. That's the entry we will pass at the third year when you have paid up your liability. So over the period of time, you were crediting with the liability, but then once the third year has passed and you have made the payment to the Becky company, to your subsidiary, then the cash will get credit and the liability will get debit because it's no more existing. Hope it's clear. If you have any question, please feel free to ask. Thank you very much.